Hi, it's Dre Griggs with Obsidian Wisdom. Today, I answer the question, how do you leave emotions out of investing? Sometimes the difference between investing and gambling are emotions. Whether or not we allow ourselves to give in to feelings, hunches, and whims, it's not untrue that there are stories of very successful investors that have hunches and they follow those emotions and it works out really well for them. I'm not here to say whether that is possible or not, but what I will say is you have to train yourself to be able to recognize those hunches. So, for example, when you hear the likes of Warren Buffett, it's well understood that he reads financial reports every single day for about 10 hours a day. While I do recognize that it is a gut feeling that he gets when he's investing, that gut feeling is one that has been trained consistently over a period of years and decades. So, when you want to make sure that you remove emotions out of investing, what we're really talking about is 10 strategies that you need to enact to ensure that you don't give in to those feelings, but instead you train yourself to ensure that you are following whatever that plan is. Which leads us very nicely into our first strategy is that you need to have a clear investment plan. When I'm talking about your investment plan, I'm talking about understanding your goals, your risk tolerance, your time horizon. Your time horizon is how long before I have to touch the money. Based on that, we already have a general understanding of how we should be investing. Most of the time, you hear me say when you're talking about investing in the stock market, that money should be able to be left there for at least 5 years because there is a variety of situations that might happen. And we need to give ourselves enough of a buffer to be able to allow our investments to continue growing. Well, I can show you a chart that shows the stock market is consistently going up over the long term. That does not change the fact that there are serious short term losses that are taking place. And if you don't give yourself at least 5 years, that normally means that we might be stuck holding an empty bag. When I'm looking at my investment plan, I'm looking at not only what I'm investing in, but why I'm investing in them. I should understand what it was that I liked about those companies. Was it their profits or their low debt to equity ratio? Did they have a mode, something that made it very difficult for them to lose their position of number one in the market share? Or is it an up and coming where we see new technology, something that's happening, and we believe that the market is going to love this advancement? Whatever it was that you decided made that company a good investment, you need to write that down, put it in your strategy, and as long as that information stays the same, you follow that plan. You stay in those investments. If something changes, where the situation changes, the company's philosophy changes, the direction changes, maybe some regulations change, whatever it is that changes that environment where the information is no longer valuable, at that point, I would investigate whether I should be selling those stocks or not. If you want to be able to remove the emotions from your investing, you're going to notice that it starts with adding logic in. Unfortunately, a lot of people are gambling where they're not dealing with logic and reason, but instead they're dealing with emotions. And if that's all your investments are based off of, then it's very difficult for us to remove the emotion because you haven't added any of the logic in your investment strategy. Number two on our list is you want to regularly review and rebalance your portfolio. If you want to remove emotion from your investment strategy, then that means we have to already have in place when we're going to review our investments, whether that's quarterly, annually, for some, I've even seen it monthly. But any sooner than that does not normally work for most investors. You either are going to be looking at the fees or you're going to actually miss out on some of the gains of your investments. But the way rebalancing works, and I'll put a link to another video where I go through a variety of rebalancing strategies, it's basically this idea that if my portfolio has a certain allocation where I'm supposed to have 70% of my portfolio invested in a particular set of stocks and then have 30% of my portfolio invested in bonds and other safe investments, if for some reason the stock market is going gangbusters and all of a sudden it's making up 80, 85, 90% of my portfolio, well, that would require me to sell those stocks so that I can go back down to that 70% allocation, which ultimately means that what I'm doing is I am selling high. The market is outperforming my portfolio allocation. So I have to sell while the market is red hot, while it's selling high. And then I end up buying low. So if my bonds aren't performing as well, I take my overperforming stocks and I buy the underperforming bonds. Now, it doesn't have to be within asset classes. You can do that within your own equities. If you have 10 or 15 stocks inside of your portfolio, if any of those stocks aren't performing well, but my investment plan hasn't changed, I would then sell all of my overperforming stocks and I would buy my underperforming stocks. That is basically us putting into place a logical approach that allows me to sell high and to then buy low. That is something that is very difficult if you don't already have a plan in place. What happens most of the time is we see these stocks performing very well. So Nvidia would have been an example of that. If you followed a video from January to now, it's gone up. If you were someone who's just been watching on the sideline, you start getting that little bit of FOMO where you're looking at it, you're like, man, I probably should buy these stocks. It seems like everybody's winning off of this. And then you're looking at it and you're talking yourself in of it, out of it. And then the emotion really starts to pull away. And the next thing you know, you're like, okay, well, if everybody's winning, right? That everybody word, if everybody's winning, then I should go ahead and buy this NVIDIA stock. And then next thing you know, NVIDIA starts going down. Well, what happened? We fell into the herd mentality, which is a bias that we have to be aware of when we're investing. If everybody seems like they're having fun, we start thinking we're the only ones that are missing out on this. But if you have the overall reallocation strategy already set, then you're not going to be following the herd. You're going to be following your plan. Your plan will require you to sell those overperforming stocks, locking in the profits, and then reinvesting them in underperforming stocks, which everyone is talking bad about, which doesn't feel good in the moment. But if you did step number one, which is have an investment plan that you believe in, then step number two is much easier for you to be able to achieve. Number three on the list is you want to automate your investment contributions. If you've ever done any lean training, any Six Sigma training, you know that the number one thing that they often want to do is remove human biases, remove human decision making, because the more human interactions we have with the system, the more likely something is to break. And your investment strategy is no different. If we're going to put a plan in place, it's great for us to automate a lot of this where we don't have to look at it, because if I look at it, I might talk myself out of it. Now, granted, if you obviously have an advisor and you already have a professional, they should be already looking at it from a very logical perspective. This is the strategy that we put in, and we believe that this is the right strategy. So we're going to stay steady as she goes. But for many of us, if we're not trained to remove our emotions from it, oftentimes what we'll do is we'll say, well, I have other things to do with my money. I have bills to pay, or it wasn't a good month, or I'm looking at the stock market and it seems like everything's going down. Is there a recession coming? And then you talk yourself out of following whatever that investment plan was. If we automate it, then there's a couple things that happen. Number one is we don't have to think about it. That money is already gone. So out of sight, out of mind, that money is already in our investment account. And so we can then breathe that a little bit of sigh of relief where it's like, look, I didn't have to make that decision. It was already made for me. Now, for those of you that are still working, it might be worth you asking your HR department if you're able to have a portion of your check go straight to your investment strategy, where it goes to the brokerage account. So it doesn't even go in your bank account. If your HR department doesn't allow you to do that, then you would just set up it automatically with the brokerage account in your own personal investment account. Either way, the day that your check goes in, you should have that money automatically pulled out and go toward your investment strategy. And the reason this is very important is because there are generally three relationships that we'll have with money. We either spend all that we either spend more than what we have, or we spend less than what we have. And out of those three choices, you and I both know which one creates financial freedom and a successful, wealthy retirement. That's going to be spending less than what you have. If you're able to invest 10 to 30% of your funds towards your financial freedom, then you're able to achieve that goal. If you always spend what's left at the end of the month, you and I both know that things come up all the time. And if it's not already set, then it's always going to be next month is the month that I'll start this investment strategy. And then another month goes by where there's always a tomorrow, but there's only one today. So if you can automate your strategy, that will make it that much more likely that you'll be able to spend less than what you make because you're already investing first and then you're spending what's left. Number four on our list is focusing on your long-term goals. I don't exactly know who to give the credit to, but it's this idea that I have short-term goals, medium-term goals, and long-term goals. And for me to achieve my long-term goals, I have to have my short-term goals aligned with my medium-term goals, which are aligned with my long-term goals. That every single day, the steps and the actions that we take are bringing us closer or further away from our goal. And that the life that we have today is exactly the life that we created from the decisions that we made 2 to 5 years ago. And the life that we'll have 2 to 5 years from now are going to be decided by the decisions that we make today. And as a result, you need to have your long term goals written out, set aside so that you know what you're going towards. Where it's not a question of should I spend my money on a trip with some friends or whether I should go out to eat at this nice fancy restaurant. It's a question of whether or not I should fund my future goals, because ideally your future goals are going to be much more satisfying than whatever your short term goals are. And as long as that's true, it should make it more likely that you can remove the emotions of the present where you just feel like I want to be a part of it. I want to be able to do this cool thing. I work really hard. I grind. I deserve to treat myself. And while that's true, the question is, what are you going to treat yourself with? I have this conversation with my kids all the time, right? It's this idea that you could buy a piece of candy for $1, or you can save that money and buy yourself something really nice with $10 to $20. You and I, obviously, the numbers may have a few more zeros at the end of it, but the principle is the same. If I buy a bunch of small, little, medium things along the way, it's going to impact that big purchase that I want to have in the future. And there's no purchase bigger than your retirement. Your retirement is going to be your largest expense. You're purchasing all of your freedom so that you can have all of your time back. And for me, there is nothing that's quite more important than that. I do understand that I do make some sacrifices sometimes, but I know what I'm sacrificing against and for. I know that my financial future is something that's very important to me. And the things that I make short term decisions on, those are very important to me too, where maybe it's something that I can do one time or maybe even twice, but it's not something I want to make a habit for. Where it's probably going to be something where it's a real emergency, something that's very important, where I recognize that the time that, for example, I have with like my wife and kids today, that's not something that I can purchase back in the future, even with all of my freedom purchase. So I have to balance the two out. You don't ever want to just have a blind spot where you allow an exception to this rule. And because I've seen it all the time where people say, well, Dre, I have to provide for my kids. And I agree with that. That's obviously true. But I've also seen where because that's the blind spot, we don't actually notice how much money's going towards that. And if you don't keep track of what you're spending, then it's always going to be the blind spot that sneaks up on you and ruins your retirement. No leaky buckets in our retirement strategy. So we remove the emotions out of it by actually having set numbers of what my long term goals are, how much I need to invest towards that, and then what I need to do in the short term and medium term so that I can achieve those long term goals. Number five is we want to educate ourselves on behavioral biases. And all this is just this idea that there are patterns. There is awareness that we have. You guys hear me talk about wisdom all the time. If you were aware of herding, which is this idea that if everybody's doing it, I want to do it. Or if you're aware of the bias of loss aversion, which is this idea that I weigh losses more heavily than I weigh gains, which is sometimes used against us. There is this study I remember reading a few years ago, and I believe it was some teachers where they gave them their annual bonus. So let's say it was $10,000, and they gave them the $10,000 at the beginning of the year. And as long as they achieved all of the goals that were outlined, they got to keep the bonus. If they did not achieve all the goals, they had to give back the $10,000. Well, because of loss aversion, that felt a lot worse than the idea of, hey, you don't get the money until you check off all these boxes. Because loss aversion, which is now that I'm holding the money, it feels different. And then when you lose it, it feels worse. Because of that, a lot of us make different decisions where we're trying to avoid loss aversion at the expense of actually gaining and profiting and achieving our retirement goals. And the third common emotional bias that I see is overconfidence, where what we'll do is we'll take this idea, for example, someone will say, invest your money in things that you understand. So you go to Home Depot and you love Home Depot, and you're like, man, every day I'm in there, my Home Depot is slammed. It seems like they have all the contracts. They must be doing phenomenal. I'm going to go buy a bunch of Home Depot stocks, which is fine as far as a place to start your investment planning. But what about looking at their financials? What about looking at their industry as a whole? What about looking at the market and their competitors and their pricing and looking at all these other variables that can then give us the sound decision of saying, okay, this is a good investment? Because ideally, what you'd want to do is you want to be able to create what you believe the value of a stock is. And then, based on the value, however you want to measure out the future projections with past projections and growth and all these other things, if there is room to grow, then you take advantage of that room to grow. If you have that opportunity where you found a stock that you genuinely believe is like 40% undervalued, well, you can get that 40% gain if you could purchase that stock. On the other end, though, if you just went to a store and had a good experience and you think that everyone is buying it because you see everyone doing it, that's not quite a sound and logical decision. Could you be right? Of course, you could be right. But is that as well thought out as the information that I just laid out? And I would say no. And so it's usually good for us to remove the emotion and genuinely write down what is it that I like about these companies? And if you can't normally list 3 to 5 quantitative benefits and usually 2 to 3 qualitative benefits, then we normally are going to say, I might be gambling instead of investing. If you're someone who's planning on retiring and you want to make sure that you have the right investment strategy in place, if you're a little concerned about some of these emotional biases and whether or not you're falling into one of these traps, feel free to go to obsidianwisdom.com/wealthy to learn more. Number 6 on our list is to limit exposure to financial news. You and I, we both know when we watch TV that their goal is to sell advertising revenue. So to do that, they normally have to make it entertaining, they have to make it sometimes educational, but they often feed into our fears. That's why if you've ever watched the news, the first story they give you, in fact, probably the first 30 minutes of stories, are all to strike fear, where deep down you have this feeling that if I don't watch this, something might happen to me. And because the media understands this, if you ever watch financial news, they sort of feed on that same feeling that if you're not watching this information, then you may lose all of your money. And as a result, you're watching it, and then they're feeding more and more into that fear. And as they feed more into the emotional fear, you feel like, I got to do something. I have to do something now. But if you ever watch those shows over any length of period of time, the reality is it's just really hard to react to the day's news. Imagine investing purely based off of the day's information. That is really hard. That's why we invest with long term approaches. Could some of the information that I find that particular day be very important for me to make a change in my investments? Of course, it's very possible, but is it equally possible that this is a very small blip on a long term strategy and it's going to come and go? Well, that's equally possible. But you and I both know that that is a really dangerous game to be playing, because the reality is most of the stuff that we see on those financial programs, for them to be that prominent, that they're being interviewed, that they're being discussed, that means a lot of the value has already been realized, because a lot of the investors, when they find these diamonds in the rough, they don't tell anybody. And then they invest in them. And then when everybody hears about it, it's because they're trying to drive the value up to increase their returns. And so we always want to take a deep breath and recognize the game that is being played. Their job is to sell advertising revenue. And to do that, they have to make things seem interesting. They have to drive into our fear and scarcity and the fear of missing out and all of these things. And because these emotional reactions do cause most of us to make decisions, it's better to just limit how much of the financial news that you take in. In fact, it's probably better to limit how much of the news you just take in as a whole, which leads us nicely into number 7, which is a cooling off period. So normally the way I like to think about it is give yourself 24 to 48 hours for most big financial decisions. If you are going to go buy a yacht, you should probably wait 24 to 48 hours just to make sure that you really want it. If you're going to book this amazing trip somewhere, go ahead and wait 24 to 48 hours, see if you really want it. Or if it was an emotional decision that you just got caught up in. Maybe a friend was talking about it, or a show you watched, or you had a bad day somewhere and you're like, I should reward myself. Just give yourself 24 to 48 hours, see if you still feel the exact same way. That is also a good strategy when it comes to your investing. If you give yourself 24 to 48 hours, allow yourself to digest whatever financial news and fundamentals that you read and the changing in the company and the concern that you have, allow yourself to feel that out. And if that decision is something that is founded in logic and reason and some data that you have to support it, well, then go ahead and take that action in 24 to 48 hours. You probably wouldn't be that surprised to find out that a lot of the investors that we love to follow don't just make decisions on a whim. They do spend time analyzing that information, ensuring that they're making the right decision. Because as you know, the rule number one is don't lose money. And then rule number two is don't forget rule number one. A part of that has to do with us making sure that we're doing the right thing for the right reason. It's not always about whether or not the results match. If you do the right thing for the right reason and the results aren't necessarily in your favor at one given time, I'm okay with that, because over the long term, you're going to win. Just like the opposite is true. If you make the wrong decision with the wrong information, but you still won big, over the long term, that's going to catch up to you and bite you in the butt. So by giving ourselves a cooling off period, we really allow ourselves to stop that fight or flight mode, where we're saying, okay, I'm not just in survival mode. What is it that I was trying to accomplish? What is it that created this fear inside of me? And what decision am I making and what goal is most likely going to happen because of that? and then sleep on that decision and then wake up the next day and be ready to make that next step if it still makes sense to you. Which leads us into number 8, which is setting realistic expectations, right? If I had a dollar, every time I saw this random ad where somebody said that they could get me a 5% return every day, a 10% return every week, and then you sit back and you think about the math, right? You actually think about the math, well, that would mean that that person is going to be able to generate me $1 billion in like 5 years. I would say, you know what? I don't think they can do that. Or if you listen to what they're promising and they say they have the best strategy in the whole world for like crypto or option trading or something like that, and you're sitting there, you're saying, would someone with 100% foolproof strategy share it? And if they did share it, would they share it for $39, $99? And I would say no. I hope not, at least. Where sometimes the information just doesn't seem reasonable. It just doesn't make sense if you set the scenario. And because of that, many people end up with unrealistic expectations where we'll sit and we'll talk and then we'll talk about the strategy and I'll give you the estimated return that I believe with what I think will be the highest return and what I think will be the lowest return, where we have our best year and our worst year. And I'll give you the confidence that we have in these returns as far as what percentage of the time do I think we will have a positive return. And because the only information that you have observed is someone saying that you should get 5%, 10% every day, every week, we end up having these very unrealistic expectations where we miss out on genuine opportunities because we're believing the hype and the foolishness. Because the reality is, at least for me, in my past experiences, when I was taken advantage of, when I did fall for a scam, it was because I was trying to get a lot for a little. The exchange didn't match. Where someone told me that if I gave a little bit of money and I was desperate, I was trying to figure out how to pay some bills, and then they would show me this amazing opportunity. And the opportunity wasn't that amazing, which really sucks if you think about it, that at our worst of times that there is someone who's going to kick us while we're down. But the reality is, if we're going to be exposed to some of these opportunities, more times than not, we're in a rough spot. We're trying to make up for lost time. We're trying to achieve a 5 year goal within 5 months. And most reputable people are going to tell you it takes 5 years. And the only people who are willing to tell you it takes 5 months are going to be the ones that are most likely to scam us. Another concern of having unrealistic goals is we don't get to measure success accurately. So, for example, if I set a goal to lose a pound a week, that would actually be a really amazing goal. But if my expectation was that I would lose 4 pounds a week, well, now I'm discouraged by 1 pound and I'm trying to do even more crazy things. Like I'm really trying to figure out a way to achieve this 4, and the reality is that's not an achievable goal. It's at least it's not a safe and healthy way to achieve that goal. And when it comes to our finances and our investments, sometimes emotionally, we have this number set in our mind that's just not very realistic. It's not something that we can do without exposing ourselves to a significant amount of risk. It's not to say that the person who said, I put all my money in Tesla and now I'm wealthy, or I put all my money in Amazon and now I'm wealthy. There are people who go to the casino and put all their money on red and they win. But does that mean that everyone should go do that? And I think you and I would both agree that realistically, the answer is no, that that is not a realistic or reasonable expectation to believe that you're going to mirror someone else's results just because it worked for them and they got lucky. Number 9 on the list is you want to focus on what you can control. The reality is there's a recession about once every 10 years. And we know that the government is making different decisions that sometimes helps us and sometimes hurts us, that there's going to be situations completely out of our control. But that doesn't mean that we can't put the best investment plan in place. And as long as we have the best strategy that we can follow in place, then whatever's going on in these other environments, we have at least accounted for it as much as we could. Where there is a level of unpredictability inside of the stock market, but that's just because we don't know exactly when it's going to happen. We have a general understanding of what is going to happen. We just don't know if the recession is going to be caused by COVID or a financial crisis because of bad mortgages or a terrorist attack of 9/11. We don't know what's going to cause the recession, but we do know that they're going to happen. We know that there are investments that take a defensive position, and we know that we can create a portfolio allocation that performs well in a variety of economic climates. And it may not perform as well as being all in on the stocks in the growth market, but it will definitely outperform those stocks in a recession or even worse, a depression. And so, as long as we're able to just control what we can control, which is our investment strategy, the allocation of those trades, and the automation and rebalancing of those investments, then we're normally able to say, I controlled what I can control. And I know that I'm going to be okay over the long term, that I can sleep at night because I'm not in an overwhelmingly risky position that requires me to wake up every single morning and make sure that I haven't lost yet, because that's gambling. Gambling is, I know that I'm on a house of cards. I know that this isn't going to last in the long term. So I have to wake up every single morning and look at my investments because I know one day it's going to happen. And investing is the opposite. Investing is, I know that I'm not going to win every day, but I have a very solid strategy in place that gives me the confidence to know that I'm already limiting my losses and I'm maximizing my gains as much as I reasonably can, considering my time horizon, which is how soon I need my money, and my overall risk tolerance, because I want to be able to sleep comfortably at night and that there's no amount of money that I should trade for my peace of mind. And that leads us very nicely into our 10th and final way to remove emotions from investing, which is stress management. Now, each of us is a little bit different. So, whether or not you need to go on a walk, whether or not you need to turn your computers off, or if you actually do need to take a look at your trades every so often, however stress management looks for you will be different than how it looks for me, because each of us handles stress differently. But it's important to make sure that we do take stress into consideration. We don't want to allow things like the fear of the unknown or different decisions that others are making to impact our own comfort and happiness and joy in retirement. So, as much as we can, we need to be able to take a step back from our investments. We need to be able to take a deep breath and just enjoy the sunrise, enjoy the sunset, take the walks, practice meditation and mindfulness. But we have to learn patience. Patience is just allowing the process to happen. I think Warren Buffett has a quote where he says that you can't get 9 people pregnant to speed up the process of having a baby. I think that something like that is what he says. Because at the end of the day, it takes 9 months, right? It takes 9 months, 10 months to have a baby. And there's nothing that you could do to speed that process up. No amount of stress, no amount of worrying, no amount of scheming is going to change that outcome. So go ahead, take a deep breath, allow the process to take place, have a long-term approach to your investments, and put the strategies in place that removes the emotional reactions normally tied to uncertainty and instead replaces it with logical and reasonable calculations that we enact, and we know what we're going to do in each of these economic climates. If you found value in this video, I simply ask for you to like and subscribe so you continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.